Welcome back to our series on advanced investment strategies. In this third and final installment, we're diving deep into the sophisticated techniques used by professional investors to navigate the complexities of the market. If you've missed parts 1 and 2, be sure to check them out. Today, we're exploring strategies that can take your portfolio to the next level. First up, let's talk about hedge fund-style strategies. These aren't just for billionaires. The principles can be applied by savvy investors too. A popular one is the long/short equity strategy. The idea is simple. You buy stocks you believe will go up, that's your long position, and simultaneously short stocks you expect to go down. By shorting, you're essentially borrowing a stock, selling it, and hoping to buy it back later at a lower price. The goal here is to generate returns whether the overall market is rising or falling. It's about picking winners and losers, not just riding the market wave. A more refined version of this is the market-neutral strategy. Here, you carefully balance your long and short positions to neutralize the impact of broad market movements. For example, if you have $100,000 in long positions, you'll also have $100,000 in short positions. This way, your portfolio's success depends almost entirely on your stock-picking skill, not on whether the S&P 500 had a good or bad day. It's a powerful way to isolate and profit from your specific insights while minimizing overall market risk. Then there's the global macro strategy. This is like playing chess on a worldwide scale. Global macro investors make big bets based on large-scale economic and political events. They analyze trends in interest rates, currency fluctuations, commodity prices, and even geopolitical shifts. For instance, if they believe the Federal Reserve will raise interest rates, they might short bonds. Or if they foresee a political event destabilizing a currency, they might bet against it. It's a high-stakes game that requires a deep understanding of the global economy. Moving away from hedge fund tactics, let's look at dividend growth investing, or DGI. This is a long-term strategy focused on building a portfolio of companies that not only pay dividends, but consistently increase them over time. The goal isn't just the immediate income, it's the compounding power of those growing payouts. Over years, reinvesting these ever-increasing dividends can create a powerful snowball effect, generating substantial wealth and a reliable income stream, which is especially attractive for retirement. Next, we can't ignore tax-efficient investing. It's not about how much you make, but how much you keep. This strategy involves making smart decisions to minimize the tax bite on your investment gains. This could mean holding investments for over a year to qualify for lower long-term capital gains tax rates, using tax-advantaged accounts like a 401k or IRA, or strategically harvesting tax losses to offset gains. Every dollar saved from taxes is a dollar that stays in your portfolio, compounding for your future. What about protecting your portfolio from inflation? This is where commodities and other inflation hedges come in. When inflation rises, the purchasing power of your cash and bonds erodes. Investing in assets that tend to perform well during inflationary periods, like gold, real estate, or even certain stocks in the energy and materials sectors, can help preserve your wealth. These assets can act as a shield, protecting the real value of your portfolio when the cost of living goes up. Let's also touch on a classic debate: dollar cost averaging versus lump sum investing. Dollar cost averaging means investing a fixed amount of money at regular intervals, regardless of market prices. This helps smooth out volatility. Lump sum investing, on the other hand, means putting all your available capital to work at once. While studies often show lump sum investing outperforms over the long run, combining the two can be a smart approach. You might invest a large portion up front and then use dollar cost averaging for the rest to mitigate the risk of bad timing. Finally, we have behavioral finance optimization. This is about understanding your own psychological biases and preventing them from sabotaging your investment decisions. We all have tendencies, like selling in a panic during a downturn or chasing hot stocks out of fear of missing out. By recognizing these emotional traps, you can create systems to counteract them. This could mean setting strict investment rules, automating your contributions, or simply taking a deep breath and stepping away from your portfolio during volatile times. Mastering your own behavior is often the final frontier in becoming a truly successful investor. And that's a wrap on our Advanced Strategies series. We've covered a lot of ground, from complex derivatives to the psychology of investing. I hope you found these insights valuable for your own financial journey. Thank you so much for watching. If you enjoyed this content, please give this video a like and subscribe for more. See you next time.